Hello, everyone. Welcome to the Equinox New Braunfels Phase 2 investment opportunity presentation. It's actually a refreshing change for us to present an existing advanced stage project with a 4% locked-in construction loan to our investors and give you a chance to jump into the project just 10 months from when the first 32 units are scheduled to be delivered. Today, you're going to learn about our favorite Texan market, the city of New Braunfels, and hear why Anna and I invested over $1 million for several years without any returns, because we believe that we've got a home run project in a fantastic location, and you'll find out why our belief in that home run has actually gotten stronger over the last 2 years that we've been working on this project. Our agenda is action-packed. After we introduce ourselves, we will first catch you up on the first 30 months, the phase 1 of this project, and then we'll share our insights on the metro, the market, and the sub-market, and then share our reasons for wanting to build at this amazing location. More than any other project that we've invested in, this project is all about location, location, location. Let's see. Ooh. And then we're going to give you several minutes. We're going to take several minutes to give you a very visual and fun walkthrough of the property's design, its features. You'll see the numbers for phase 2 in detail, everything from assumptions to loans to splits to returns, rents, and a lot more. We'll give you the timelines and the investment minimums, and then we will jump into a detailed Q&A session. Some quick housekeeping. Feel free to type in your questions into the Q&A box, Anna will be asking us these questions at the end, and you will get a copy of this webinar in your inbox in 48 hours, just in case you need to jump off. Please note that the numbers might change, though given that you're investing in phase 2, we think that they're pretty dialed in. Our lawyer wants you to know that this webinar is not a solicitation to purchase securities. For that, you would need to review the PPM and the subscription docs. Our goal today is to get you comfortable with the information so you can continue your due diligence with the investment summary and the subscription documents. In case you're new to Grocapitus, we manage a portfolio of nearly $1 billion spread across 32 projects with 7 projects sold. Over 900 of you have given us almost $280 million of equity to buy assets like the ones on the screen in blue, or to build new construction assets like this set on the right that's in green, or to diversify your portfolio using assets like these in orange here. No matter the type, our portfolios outperform those that have chosen to not be as patient as we have been and to deliver long-term returns to investors. And there is no better proof of our hard work and our cutting-edge use of data science and our investor-first attitude than this slide. In this white box on the left, you can see the original projections. And then in the blue box on the right, you can see that we doubled both the IRR, that's time value returns, and the AAR, that's simple annual return, on the 7 projects that we've exited so far. And remember, we had to deal with COVID challenges, delinquency, rent control, eviction bans in 6 of these 7 assets. But we made the right decisions, painful as they might have been then, and the results are in front of you. Our investors love what we are doing. Here is Jennifer. She is a super experienced investor, and she compares us to much larger companies with more projects, and she thinks we come out ahead. And she also really enjoys our high efficiency processes and likes the fact that the team has not changed since the beginning. And here is Dr. Pada. He's a general partner with lots of deals on his own. Check out his comments, by the way, in orange. It really comes down to true use of data to optimize results. And we are very, very good at that. And that's why Dr. Pada keeps coming back to us to invest. Okay, let's introduce the team. I'll start off. My friends call me the mad scientist of multifamily because of my focus on data science, process-driven improvement, and also data-driven testing and analysis. Anna has been my partner on this journey since 2018 when Grocapitus began. Say hello, Anna.
Hey, everybody.
And most of you on the call know us well, and dozens of you on the call today have invested in past projects. We are very passionate about real estate investing and its tax benefits. Anna and I spend a lot of time each year traveling throughout the country, and neither one of us thinks that we've come across a location better than the one that we are talking about today in all of these travels. Anna and I lead a very experienced group of dedicated team players led by these 2 experts. On the left, Pete Levine brings both his academic and real-life experience to our team. No one's more tied to data-driven decision-making than Pete is, and every project that we have benefits from his amazing sourcing and underwriting and due diligence skills. And when you think of Megan, think of a hawk with sharp claws watching over our projects, counting every dollar. She never hesitates to put a property manager in their place when she's trying to maximize rents or speed up the rehab at our properties. Her team documents their hard work in detailed project updates that all Grocapitus investors love. And Megan and Pete, they've aced the successful completion and lease up of a similar townhome 66-unit built-to-rent community in Idaho Falls. Here are the final pictures of this townhome community. And their teams are taking all of those lessons learned and they're pouring them into phase 1 and phase 2 for the new Brunfels townhomes. In case you're wondering, the Idaho Falls community, the one we just showed you, it's not our only completed townhome project. We've also built more upscale townhomes like this 46-unit community in Raleigh-Durham. Check out the completed pictures. They're lovely. And the team's also finishing up a fourplex build-to-rent townhome-style community, now leasing up in Houston. Take a quick look at the amazing quality of this product. So we consider ourselves somewhat of an expert at building townhomes, but we've also completed many apartments and student housing and flex industrial projects successfully, and we're proud to show you the finished product on some of these projects. Every project had obstacles that our team had to overcome, so the experience has made us a savvy team, a nimble team. Sounds good. Let's finish up by looking at the financials and also at the investment returns. First, skin in the game from us, $500,000, $500,000, and potentially $2 million from our builder. Now, do note that Anna and I have had over $1 million invested in the property for nearly 2 years. And we don't expect to get half of that back until the end of this year. So this 500K long-term number really does not show our true commitment to the project. The project size is 44.1 million. I will discuss loans on the next slide. Our build to cap rate is fantastic at 6.6%, if you know what that means. Total equity to be raised is right here, 16.5 million. Of that, 4.5 million is phase 1 equity, so in the past, and then 12 million is phase 2 equity. Note that we've set aside over $2 million in contingency, just in case construction or material costs go back up. And we've stress tested this model extensively, and we've provided the stress tests in our investment summary. Now, this is by far the most important financial slide. We love this project so much. We are so confident of success that we signed a full recourse loan for this project, recourse to us. This amazing loan, it's locked in at 4%. And we can get 60% of the way through the construction with this loan. Fixed 4%. Our lenders must love this project. The loan's for $15 million. By the end of this year or sometime next year, we'll switch to a phase 2 loan, which would be $27.5 million. That one will be a floating loan. And based on current quotes, we're pretty comfortable with that 8.2% lender on number on the screen. Now, why 2 loans? Well, taking on a smaller phase 1 loan allows us to boost profits by keeping the interest rate fixed at 4% all the way through this rate hiking cycle. And then, since this rate is really locked in until next year, we can decide the right point at which to switch to phase 2. We wait until the Fed signals a rate cut, sometimes this year, after which the spreads compress. They will fall, giving us access to lower interest rates. With a locked-in loan, we get to decide when to switch, which is why a 2-tier model gives us huge cost savings, but also huge flexibility. All right, moving on. Who's our builder? Well, Drake Tappy is local and have together built over $500 million worth of projects. We're negotiating with them to invest $2 million of their hard cash, not their profits, but current hard cash into the project. While this isn't a 100% done deal, we are very confident that they'll make this investment. And they're just as excited about the project as we are. Really good builder team. And our property manager, very strong, Capstone Real Estate Services. They're a full service third-party management firm. They're managing 33,000 multifamily units, 500,000 square feet of commercial space. They were founded in 1969. They've got 12 offices in 7 states with 1,000 employees in 95 cities. and they will have a full-time property manager on staff and a full-time maintenance employee at our site. Capstone's done extensive market surveys, and they feel very comfortable with both the projected rents and the projected occupancy. And while we do trust our property manager, we rely on expert institutional grade third parties to verify their numbers. The Myers Research multifamily market study is nearly 100 pages long. It's studied the project. It's concluded that the proposed property is a highly viable use of the site, and there is strong market demand. And it also says that our development is actually located in a very desirable submarket of New Braunfels. And it goes on to validate our rents, our occupancy assumptions, our cap rates, and a lot more. So it's definitely worth reading, and it's included in your investor kit. All right, let's go over splits and fees. The developer fee here on the left is a standard 5%. However, we've decided to hold back half of the developer fee all the way to refinance or sale, only for this one project, by the way, and it reduces the equity requirements and it boosts the cash flow and the profits. The asset management fee is a standard 1% of equity raise, which starts after the property is occupied. Our recent development projects in UGRO, you probably know this, have higher splits for us, for the general partners, but we've chosen to stick with a standard 70-30 split, 70 for you, 30 for us, once again, to boost your returns. Because the loan is very large and it's a recourse loan for us, there is a 1% loan guarantor fee and also a 1% disposition fee when we sell the property. The preferred return, or PREF, varies from 6% to 8% for our equity investors. And then there's also a 12% PREF return class for those that are focused on lower risk and don't want to participate in the upside. Now, one item to note, once you hit an average annualized return, or AAR, of 26% a year or higher, then there's a bonus tier for us, which is determined at exit. Only the portion of profits above that 26% level are split 50-50 instead of 70-30 between limited partners and us. To repeat, this 50-50 bonus tier only affects the portions of the profits above 26% per year, determined at exit, only if we overperform. What about depreciation? Well, because you're coming into phase 2, you don't have to wait until 2025 for your depreciation. You'll get depreciation in 2024, which is next year. There's also the potential of depreciation this year, and we're working on that, so we're not making a promise. Either way, we expect depreciation at around $50,600 for every 100K invested. All right. Accredited investors can invest in 4 different ways in phase 2. The vast majority of you that have invested in our projects invested in the equivalent of the B classes, B1, B2, B3. And the difference between these 3 classes is this preferred return right here. B1 investors get a 6% pref after the coupon investors, class P, have been paid. For B2 investors, that pref bumps up to 7. And for our B3 platinum investors, the pref goes to 8%. Now, B3 investors here get the best of both worlds because they get the highest pref and they get the benefits of the back-end profits. 200K is the minimum to invest in B3 class. If that's too much, look to invest in B2 with 125K minimum or B1 with a 75K minimum. All of them still have substantial prefs. Finally, if you are very risk averse and you don't care about the upside, you can invest in class P, popularly known as coupon. There's a 100K minimum and a huge preferred return of 12%. This one's going to get sold out very fast. Now, class P coupon investors don't get any back-end profits, but they do get depreciation. But they have an advantage over the other investors. They get first dibs to the return. So a lot lower risk, a lot higher cash flow, but no back-end profits. With class P, your pref actually starts to accrue immediately on investment and starts paying out in December this year. Now, there is absolutely nothing to prevent you from investing in both the class P coupon as well as the class B equity. So you can invest, let's say 50,000 in class B coupons and 75K in class B1, and you can get the best risk reward balance. Though my favorite would be 100K in class P and 200K in class B3. This is what I would suggest to all of our experienced investors who truly know how we've performed. Here are the returns, the syndication returns for class B. We're showing you a 4-year hold projection. This is a 4-year project. And you can see that there's no cash flow in year 1 because of construction, but all the classes have strong cash flow projected in year 2. Now, overall, if you look at the table on the right, Class B1 should receive a 25.3% return with a 2x equity multiple. Class B2 is projecting 26% with a 2.04 multiple, and B3 almost a 27% return with a 2.06 projected multiple. Now at the bottom, Class P, coupon class, it's different. It's just projecting 12,000 in cash flow in year 1, 12,000 in year 2, and then the coupon gets paid back after the 2nd year. Please note that Class P investors do get depreciation benefits, just like Class B investors. So that's a big deal. Keep that in mind. We end this presentation with the top 10 reasons why we think that this could be our best build-to-rent project ever. First, the construction loan. We can get nearly 60% of the construction done with a 4% fixed loan. That's just outstanding. Second, unlike our apartment projects, you get depreciation next year and possibly even some depreciation this year. Third, we've just shown you 3 townhome projects we've completed. We really understand townhomes. Fourth, you're not taking any zoning, entitlement, approval, or permit risk when you invest. And fifth, you're getting to cash flow faster because of stick-built townhome construction. Sixth, this is not a time to be fearful. It's a time to be greedy. The buy versus rent gap is the highest in history, forcing higher income tenants to rent, and they don't want to live in apartments, which is creating tremendous growth for this build to rent market. And lastly, we've proven to you completely that the city that we're investing in has absolutely insane demographics and growth, and our neighborhood is one of the best in this city. This is a terrific project that we are very proud of. We'd be delighted if you could join our labor of love. And that's our presentation, folks. We know that many of you have questions, so we'll take your questions at this time. We are putting up a poll. Anna's going to have it up on screen in a second. There it is. So you can let us know about your interest. Please, please, please answer the poll, whether you're interested or not. It really helps us. Oh, and Anna is now putting a link in the chat. And you can also see this link on the screen at the top here. I'm moving the mouse over it. There you go. So you can just go to this link and you can invest now. This link is live, so you don't really have to wait. Note that some of the typical slides like rent comps and property taxes didn't make it to the first part of the deck, so they're in the second part. We do have those slides in case you have questions about rent comps or property taxes. All of that information is also in a very detailed investment summary that we are including in the kit. Once again, the link for the kit is in the chat, and it's also typed up here. That's our presentation. Over to Anna.
All right, you ready for some questions?
Yes.
I'm going to start with a softball. Are the garages 2-car?
They are 1-car garages. So what we are doing is we basically have a 1-car garage, and then they've got space in front of that to park the other car. There's also some parking in the project wherever possible. We provided additional parking. But 2-car garages, the mathematics don't work. The truth is, if we were going to try and emulate everything in a single family home, we would have the same problem that these people already have. The mathematics don't work. They can't afford it. So there has to be some trimming. What we've found is 1-car garages are pretty popular because the car that they want to use more often goes into the garage. The other one goes somewhere else in the community.
What is the projected rent growth for this project? Recent data shows rent shrinkage in Austin, San Antonio area for the last 6 to 12 months.
So rent growth for the United States was flat for the last 12 months. You are correct. Austin has seen shrinkage in rents, but only in the 1 to 2% range. But keep in mind, though, what you're talking about is the apartment market. The build to rent market is seeing increases in rents. The reason for that is shortages of build to rent. There's a very, very small amount of build to rent in the United States. So earlier in this presentation, we showed you a Berkadia comment, and that comment talked about significant increases in rents. We're still seeing pretty significant increases on the build to rent side. Anna, what slide should I use to show rent comps? So
rent comps would be, let me see, it would be 94. There you go.
So we've done very recent surveys of rent comps, and we're pretty happy with the way rents are going up at this point of time. We're not projecting significant increases or huge increases in rents. So we're, in that usual 2.5% to 3.5% rent comp range. But once again, BTR is different from apartments, and it's very problematic to talk about that. Just so you know, the average occupancy for BTR in our market is 99.5% with zero concessions. 99.5, not 94.5 or 95.5, 99.5 with zero concessions.
Now, this market survey from Capstone, so this data came from a market survey from Capstone that they just did, I think it was February or March, and it's several pages, and it is included in the investor kit. So the documents within the investor kit will include this information. In terms of rent growth in the pro forma, we have an underwriting walkthrough, which will be available in about 2 days, which you can, Pete Levine is walking through the model with myself as well. I do believe that the projected rent growth in the model is 4% year one, 4% year two, and then 3% for the following years. As Neil mentioned, inflation isn't going anywhere for a while. And while we might have seen some retrenchment from some of the increases, we feel very confident in these numbers that we're no longer looking at 2% rent increase as a projection for the next few years, especially in this area. So I do believe that those are the projected numbers. Let's see, for our mad scientists, what is the future population growth and employment growth numbers for the next 5 years?
Well, it's very hard for me to project that. The numbers that we showed you were really based on past numbers. Future population growth numbers would be speculation, so I'm not going to get into speculations. All I can tell you is this market is currently growing at an absolutely astonishing level, and I don't expect that to change. This is a compression market. On one side, San Antonio, 1.5 million people. On the other side, Austin, which is the hottest market in the United States, with roughly 1 million people. And this is a compression market. It is the only city over 100,000 between those two markets. So it's getting compressed on both sides. I believe it will continue to outperform on population growth, job growth, income growth. All of those it'll outperform. Whether the numbers will be as incredible as what you're seeing on the screens, I don't know.
Somewhere I originally read this community had 111 units, but some of these slides show 122 units.
That's correct. Happened? Yeah, so originally the community was meant to be a fourplex for sale project. And when you're doing a fourplex for sale project, you basically have to make a fourplex and then to make photocopies of it all across the project. But once we pivoted to a syndication, we wanted a unit mix. So we took some of those 3-bedroom fourplexes and converted them into 6plexes with 2 bedrooms. So the number of units went from 111 to 122.
Yes. Does this project qualify for a 1031 exchange?
Would be very problematic. I mean, that's my answer, but Anna, I'm going to leave that answer to you.
The answer is no, it does not qualify for a 1031 exchange. However, we do have other projects. If you are in the midst of a 1031, we do have some other things that you may be interested in looking at. And so I would recommend that you email me at anna@grocapitus.com, and we can connect you to try and solve your 1031 dilemma. We're always happy to do that. Let's see, can you elaborate on property tax planning and how it changed this year? I think property taxes, Neil, which is 92.
92, okay, I will find it. Well, how it changes is really a straightforward answer. I mean, property taxes are going up everywhere in Texas. And so we are hiring Morrison and Head, who are experts at property tax valuation, and their table shows the result. As you can imagine, they are bumping up the results as property taxes go up all across Texas. So these are numbers that we feel are sustainable. Property taxes are fairly expensive in Texas. There's not much we can do about that, except to include reasonable numbers, reasonable property tax numbers in our overall financial projections.
Let's see, what is the exit strategy? Is it to sell the property after the 4th year?
It is, though I have to say this, I mean, I'm getting older, and if investors are interested in keeping a property for longer and it's at 8 or 9%, with your blessing, we'd probably want to keep this longer. I mean, it is an absolutely fantastic project in an absolutely amazing location. It takes a very, very long time to find and build a property like this. I wouldn't have an issue with keeping it longer if the investors were okay with it. So a lot of it really depends on where the cash flow for the investors is. If the cash flow is coming in really strong, then, and as I think it will, then who knows? I wouldn't have an issue with keeping it longer.
What's the reason you switched to syndication from turnkey fourplexes?
So as the market changed, those turnkey fourplexes, their valuations on those changed because fourplexes are basically single family. And as the market turns, it becomes harder to get appraisals on them and harder to get loans on them. So in the last 18 months, it's become harder and harder to get loans on those fourplexes. And so we pivoted because the investors felt, oh yeah, if I don't get a loan for a certain amount, I'm already locked in for a certain price, then I'll have to put more equity in. I put more equity in, that reduces my annual cash on cash return on a per dollar basis. I think those were reasonable concerns. We agreed with them, and so we pivoted. Keep in mind that many of those are not issues at all on the new construction syndication side, because and you saw that with our construction loan, right? So, 4%. I don't think that there's any way our fourplex investors can get a loan under 6.5%.
Can you revisit the construction phase 1 fixed loan transitioning to the phase 2 floating rate? And I'm going to tie in a couple of other questions here. How do you view the duration of the 8% rate? And what's the contingency plan if the Fed doesn't lower the rates, and in 2024, 2025, there's no guarantee that the Fed is going to lower? So what would happen then? So
keep in mind the total amount of money that we need to build a project, and you can see this on the screen. The total amount is 27.5. So the first loan is $15 million, and we'll basically get an interest rate that's 4% fixed. Now, this rate on the right, it's not based on the Fed lowering anything. It's based on the Fed doing nothing and we kind of staying where we are. Maybe the Fed increases interest rates by a 1/4 point or a 1/2 point in the May and June meeting. So this isn't a bullish assumption. We can't assume that the Fed will drop interest rates at this point. So we're not assuming that. This is just where rates are at this point for a recourse loan. So can rates go down? Absolutely, and I'll explain why. So there's this perception, most people misunderstand this, that when new construction loans are made, those loans have two components. So one is called SOFR and one is called spread. SOFR is that Fed funds rate, right? So the Fed's been raising rates, that's called SOFR. And then something on top of that is called the spread. And because there's been a lot of fear amongst lenders on how high the Fed might go, the spread, which is a risk premium, is extremely elevated. It's massive, it's huge. Now, once the Fed says, okay, we're going to stop raising rates, we think we're done, and we'll just float along for a while, that spread starts to collapse. So you can get lower interest rates without the Fed cutting, as long as the Fed has signaled that they're pretty satisfied and they want to stop. We believe that the Fed will signal a stop as soon as May or June. And so, our rate is locked in until next year. And we don't think that we need the new loan until about November or December. So we'll keep going with our 4% locked in rate, building phase 1. By November, December, we're pretty much done we've spent all of that $15 million, and we're really now starting to look at the next loan. I think that's plenty of time for the Fed to signal a stop, which should collapse the spreads. And I believe that if we collapse the spread, we should be able to get a lower than 8.2% range. But if they don't, then 8.2, that's what we're projecting. So we've got some buffer there.
And when would the phase 2 financing be solidified, signed?
We would think probably Q4 of this year. Keep in mind that financing for anything today is harder. But if you were a lender, which would you finance? A brand new project where no shovel has broken the ground, or a project where 36 units are going to be ready 1 month after you gave us a loan? Think about it.
Yeah.
We have a huge advantage there, huge advantage.
Is rent to buy an option, I guess, on exit?
It's not, because there's going to be 122 different tenants living there. I think the rent to buy is a very complicated process, and it's only done in a certain edge cases. It's not something that we would be looking to do. But I wanted to point this out to you. It's possible to do it, though it requires certain changes because of the way that we structured this community and it was originally built. It is possible to do it. Would we be wanting to do it? Probably not.
Let's see. Is it possible to invest in this project as a non-resident Canadian?
No.
How long will this be open to investors?
As long as we need once we get to the 16.5 million, docs are signed, it closes. So the short answer is it depends upon the level of interest that we have from our investors.
How does investing with an IRA work with depreciation?
My understanding is depreciation is a benefit on your normal income. When you invest with an IRA, I don't believe that you can get any depreciation benefits on it.
That is correct. That is well, I should say, Neil and I have the same understanding. Let's see. People are wondering about the Class P. How is it that the Class P is able to start paying in December 2023?
So two different reasons. So I'll just go to the Class P slide. Number one, we have 32 townhomes that are delivering in January and will lease up in February and March. So we've got some room there. But the biggest reason is for Class P. Class P is a pretty small portion of the stack. So I think it's like less than $2 million. So for that portion of the stack, we've actually accrued some initial amount of money that we are going. So we put a bunch of money in our pocket that we can give out to people, starting in December. But we're also going to be in a better position because we'll have units delivering, and we might be able to get some of that and reroute it to Class P as well. If not, we've already got it banked.
Let's see. When do investors start getting returns? Does it change for Class B or Class P investors?
As I mentioned, Class P starts getting paid. They basically get a 12% preferred return from the day of investment. So let's say you make an investment, 2 days from now. Well, your clock starts ticking, but you don't actually start receiving cash flow until December. So it takes about 6 months to get to cash flow. But once you're at the point where you've, over 2 years, we return your money. And at that point, any portion that we haven't paid you between June and December also gets paid out together with that payment. The returns for B1, B2, and B3 classes, they get paid. So there's nothing in the first year of investment. So the first 12 months of your investment, that's not a calendar year, by the way, the first 12 months of your investment, there's no returns because it's a construction site. And then we start paying out returns here, and then more here, and then more here.
Will there be any difference in returns between early Class A investors and current Class B investors?
Yeah, that should have been in the deck. I believe that there's a kicker, a small kicker for those Class A investors. Was the kicker 10%, Anna?
No, it's higher than 10%, but these are people that have been in for a lot longer. The other thing is that the Class A investors had a minimum of $350K to gain entry into the project, and some of them invested $500K. So these people had a much higher investment.
That's right. Most of them invested $500K.
Yeah,
right?
Yeah. So the lowest amount accepted was $350. So and they've been in for, at this point, 18 months. They took on all the entitlement risks. They came in before the project was where obviously had all those risks that we spoke of. And so they took on those risks. So it's common in a new construction project that the tranche 1 investors that take on early risks receive a kicker. But they don't start getting paid any earlier than Class B investors. Let's see. Can you go to the timeline, please, Neil? When did
Sure.
you say construction will start on phase 2, and when will the entire project be complete?
Sure. Let me see if I can find the timeline. Okay, here's the timeline.
Okay, also, do you project that private equity firms are still going to be looking to purchase BTR projects even before completion?
No, we're not at this point assuming that we will be selling this project before completion. This is a regular syndication project. We will basically lease it up like a regular project. We'll run it for a year. That way we can get higher leases. Remember what the first time a new construction project leases up, you don't try and get the maximum market rents. You usually just rent up the facility as quickly as you can to get to safety, to get your construction loan down, and you wait for a year and then you basically maximize the rent. So we're not thinking that this is going to be sold to private equity before completion of the project. It's going to be a regular lease up and then a hold for a minimum of a year, and then we'll see what our cash flow is like and decide whether we want to refinance or sell. What was the other question? There was 2 parts to that question.
Just the timeline. She wanted to see
right. Yeah.
when the whole thing would be completed.
Right. So that phase 1 investors came in here, and keep in mind, Anna and I put our money in a very long time ago. The project was, we put our money in 2021. The project was put into contract. The land was put into contract in September 2020. So it's been a long time. So here, all of our construction basically, you notice, is finishing here. So right here, see this 2024 November. So that's about 18 months from now is when all of the construction is done. Now, notice the lease up period starts early because phase 1 starts to lease up in January next year, because January next year is when we are delivering 32 units. And then I think that there's another 8 units that gets delivered here in the April timeframe. So this is all lease up. So, so we lease up here, and there might even be a little gap here, and then we start leasing up the other units that are coming online in August and September and October and November, December of next year. What's nice is with townhomes, you can, once you finish buildings, you can apply to the city to rent out those units.
I have read that New Braunfels is mostly in a flood zone. How does this impact your project?
Our project is graded. It's on a significant slope upwards, which, by the way, cost a substantial amount of money. So we are actually at one of the highest points in the city. The park that's next to us, Mission Hill, is the highest point in the city of New Braunfels. And that is why the park is being built there. It's the highest point on the entire city.
It's a very historical part of the city too, because it was the highest point. So there's a lot of history behind that park, and they're building this out to commemorate that history. And so we're definitely not in a flood zone. We're literally built on a hillside.
Mm-hmm.
Let's see. We'll see. Can you show cash flow calculation? So this person is asking, can you show cash flow calculation with loan servicing, tax, property management, et cetera? How does it look in future years? So Pavlik, this includes all of that baked in.
Well, keep in mind, so when we show you this number here, right? So you notice no cash flow here in the second year. This number is based on 75K. This number is based on 125K. This is after all of our expenses. So this may be a good time for Anna to talk about the underwriting video. Anna, do you want to tell us more about that?
Sure. So for those people that really love to get into the numbers and get super nerdy, we always do an underwriting walkthrough. It's a recorded video, because we don't provide our Excel file as part of our investor kit. Instead, we do a detailed walkthrough where Pete, our Director of Acquisitions and Development, and myself are walking you through each screen of each tab of the Excel. Pete is going through all of the assumptions in very great detail of every single tab to explain all of the pieces of the underwriting and what went into it, where we added, conservative, where, everything is in very geeky detail. So that will be available tomorrow. We're just putting some final touches on it. We just finished the recording, and it will be part of the investor kit. I welcome you to watch it. It's about, I think it's about 40 minutes long. Let's see. If you decide to hold the property longer than anticipated because it is cash flowing, will all investors be required to stay, or will they be paid out?
So the short answer is, if we were to keep the property, its cash flow would be pretty high, right? I'm just going to invent a number at this point, but I think it's a reasonable invention, 9% or 10% cash flow. If a property is cash flowing at 9 or 10%, I think that if you really want to sell your shares, most people wouldn't want to sell their shares, but assuming you want to, I think the best buyer for your share is some other investor in the property, and we'd be happy to send out an email. I think most people would be happy to buy your shares. Would they buy them at the exact value for the market? No, but it's not like we can sell 1/50th of the property and keep 49/50ths of it. So I think that there has to be some compromise there. In general, though, we will exit this property in 4 years unless something unusual happens on the rent, on the cash flow. If we're wrong on the cash flow and it's much higher, I don't think any of you will want to exit. In the end, though, I mean, we're not suggesting we'll keep the property for 10 or 15 years. What we're saying is we might choose to keep it for another few years, keep getting that higher cash flow, keep moving up the value of the property. Remember, rental properties are sold based on their rents. So if the rents are moving up, it does make sense to hold on for a year or two, enjoy the cash flow, and then you get a higher selling price later, which we haven't projected.
Why does the rental income not start the same time lease up starts?
Because we are required, because of the way our loan is structured. Let's say we finished 32 units in January and we lease them up in February and March and April. Well, by the end of April, we've got the cash flow from them, but we're required to pay the loan down. We're required to use it to pay the interest on the loan down because the property isn't complete at that point of time. So we can't use that money to pay you, but it does help the project because it's paying down the interest.
Let's see. How does the decision to keep the property get made? How are those decisions made on when and how to exit?
So the standard decision is we will exit in 4 years. That's what we've told you about, and that's sort of the normal or the default scenario. If we're looking to keep it for longer, we would have a session with the investors, sort of an open mic session. All the investors come in, turn on their camera, talk about it, and we basically get a sense of it, do a poll just like the one that's on the screen right now. And when we do that, it gives us a sense of where we are. We want to do what's best for the investors. I mean, we can't get money from you again if we do something that you don't want to do.
How does this kind of investment compare with traditional investment where I can buy, own a townhome or single family home by investing a similar amount?
Well, you're asking us to be speculative, but what we would say is 9 out of 10 times, if at today's prices you buy a single family home or you buy a townhome, both your cash flow and the returns would be significantly lower than this. What allows us to increase the cash flow is that institutional buyers pay a lot more than you as an investor would be willing to pay for townhomes, because they have a 10-year hold, they have cheaper money, they have access to, for example, an institutional buyer in my area is CalSTRS. My wife is a teacher in Hayward Unified School District. They've invested $800 million into properties, and for CalSTRS to break even on their pension fund, they need to make only 7% a year, 7%. So as far as they're concerned, they buy really, really nice, good-looking new properties and then hold on to them for 10 years. And they can get their 7% and more. So there's so much institutional money that doesn't need a 20%, 25% return in a year. They're fine with 12 or 13%. That these properties get bid up when you sell them. And that's what creates the additional profit that you can't really get when you're trying to be a landlord. Also, this is an investment. You're not a landlord. So keep that in mind, that when you buy a single family property or a townhome, you are an employee of that property. You have to put work in. Here, you don't.
Does the distribution waterfall, being the capital, pref, and profit share, differ between classes of shares? And do certain classes get paid before others? So you may want to go to the slide above this that shows the 6, 7, 8, and 12.
Right. So keep in mind that there's a preferential return, a preferred return, right? So assuming, so these classes are all next to each other. So B1 doesn't have a preference over B2 or B3. They're next to each other. But let's say that we had $30, right? Well, what we would do is first we would give $6 to B1 and 7 to B2 and B8 to B3 all together.
Don't forget about class P.
Yeah, well, after we paid out the class P. So P has the highest priority. So, if you had $50, we'd give, that 12% of that here, and then we distribute the money to all of these, not so that, B1 has higher priority than B2, B2 has higher than B3, but the amounts that from the cash flow that they get, B3 gets more, B1 gets less, but they're all next to each other in parallel with each other. Who's ahead of them? Class P is ahead of them. And also,
yes,
and class A right here,
class A is equivalent to the class B.
Right. So class A is also ahead.
Yeah, they're writing, no, class A is at the same level as class B in terms of when they get the returns. So class A and B are in the same boat, and class P is in the boat ahead of everybody. Right.
So 12 is ahead, and then A, B1, B2, and B3 are basically parallel to each other.
That's correct. Can IRA money be used for an investment?
Sure.
Why? Yes, it can. Yes.
Yes. Yeah. About 20% of the money that we receive, 15 to 20% in our projects, comes from 401k solo and IRA investments.
Are Class P shares paid on a monthly or quarterly basis? And are Class B shares paid the same way? So it is quarterly.
Quarterly for Class P, quarterly for Class A or B1, B2, B3. We're just paying quarterly. We find that monthly payments are problematic for us.
Is the depreciation you mentioned, which is effectively $50K over per 100,000, over a period of 4 years? How does depreciation work with Class P?
So
we have to pay taxes on the depreciation when we receive our original capital back.
You don't have to pay taxes. Your depreciation gets recaptured. So let's say you give us $100,000 in Class P today. Well, you will then get depreciation on that $100,000. Remember, we showed you roughly a $50,000 depreciation. Well, you won't get it for this year. Remember, we were saying you'll get it in 2024. You might get it in 2023. We're working on that, but we don't have that. And then when you get your money back, then at that point, that depreciation gets recaptured. So you get $50,000 in depreciation in a certain year and your taxes go down. But then you get $50,000 recaptured in the year that your money comes back to you and your taxes go up. Now, obviously, if you're investing in Class B1, you get to keep that depreciation for much longer. But then that's the benefit of investing in Class B1, B2, and B3.
Let's see. Let's see. What numbers are being used for the projected equity of the 70-30 split, and how was this projected?
I'm not sure how to answer that question.
Yeah, I think there's a couple like very nitty-gritty underwriting questions, and again, I would encourage those people because this isn't a point where we're going to be opening up the Excel model. We really would encourage you to watch that walkthrough. You can run it as fast or as slow as you want, repeat it. It's very, very detailed. Every single cell is gone through in that model, and a lot of explanation about the assumptions and everything. Lots of detail about the loan. People are asking pretty detailed questions about the loan. Really encourage you to watch that video. The video will be available tomorrow. It'll be on the investor kit page. Again, we've recorded it just today, so we just have to put it all together. The kit page is available out there now. And that is the link that is, Neil, would you please go to the page, the poll page? Yep. It's grocapitus.com/kit. EXND-kit. That's live right now and has the link to the investor docs. It's got the link to the investment summary. It will have a link to the deck once we close out tonight and put the deck up there. The replay will eventually go up there, but it also has the link to the that investor kit, which is a web page. On it has a link to the folder that has all of the legal docs, all of the PPM, the OA. So for those of you that really love a good waterfall reading before going to bed, it's there for you. You can dig into it tonight. You can also see the market study that was mentioned earlier and the capstone market survey. All of those things are in that investor kit. And in fact, if you're looking at how would I do if I was an IRA investor, how do I do that? There's an entire folder there on how to invest as an IRA investor. There's also an FAQ there. So for people that are looking to, there's probably about 30 different questions answered in the FAQ. So I definitely recommend that you guys run through that as well, because many of your questions may be answered by looking at the FAQ.
All right, we're getting to the end of our time, Anna.
We are. Dawn asked, why are you not willing to share the financial information other than in a video? He suggests that most others share this information.
Our spreadsheets are proprietary, and some of them have information that we've taken from other partners, and that information is really not, those systems and processes are not really ours. Our partners are letting us use them. So we're not allowed to give those out. But we don't believe that every syndicator hands these out.
No, I think
and new construction is almost impossible to get these, because it takes us years to design them.
Yeah. Let's see. Can I renew Class P for another 2 years since it's a 4-year project?
Only if we need it. So that would be, I suppose, good for you. But our goal is to pay off the Class P by using a refinance. That way, we redirect the profits that you would have made on Class P in that 3rd or 4th year. We redirect those profits to our B1, B2, B3 investors. That's why we do Class P. Otherwise, we just have everything as B1, B2, and B3, and we wouldn't even do Class P. Our saving really is that we pay you for 2 years, and the remaining 2 years, what we would have paid you ends up going to our investors, the B1, B2, B3 investors.
What's the impact of rent pressures on cash flow with rents potentially going down?
I think we've done quite a bit of that analysis in the investor kit. And I think the biggest, most likely scenario, which has been known to happen, is that your cash flow for that first year, when you were renting up the property, if we're having trouble with rents going down, we typically then tend not to have cash flow in that year. So that is a reasonable worst case scenario to discuss. The following year, when the market bounces back, we always find that rents return back to the original trend line. So we get to have a chance to make it up.
I heard that you say that 50% of the $1 million investment originally put in by the partners will be taken out by the end of this year. Why are you not staying invested through the end of the project for the full $1 million?
So that we can take some of that money and buy land for the next project. Yeah. That's how we function as a business. So we've had $1 million invested for 2 years in the project. Eventually it'll become 500,000. That remaining 500,000 will go towards the deposit for the next piece of land.
That's how it works. Always got to have irons in the fire. All right, Neil, I think we are there.
All right. Well, I wanted to thank everyone. There's over 100 of you still listening. Thank you. And thank you, Anna, for putting together this presentation. We will be in touch with you, and thanks for letting us know through the poll about your interest. Have a wonderful rest of your evening, everyone. Bye-bye.
All right, thanks. Bye.